One might ask, why would the UK government decide to buy a stake in Lloyds Bank? A question that has puzzled many. To understand it, we need to delve into the world of economics, government decisions, and the banking industry. This isn't a tale of simple investment. No, it's a narrative rich with strategy, risk, and a pursuit of stability. You see, the government's decision to buy a stake in Lloyds Bank wasn't just about acquiring shares, it was a move aimed at ensuring the bank's survival during a tumultuous time, a strategic step to protect the economy from the ripple effects of a potential banking collapse. Imagine the domino effect that could have ensued had Lloyds Bank, a key player in the UK's banking industry, gone under. The impact would have been felt far beyond the banking sector, reaching into every corner of the economy. This decision wasn't made lightly, so how did we get here? To understand the present, we must first explore the past. As we journey back in time, let's take a moment to appreciate the storied history of Lloyds Bank. Founded in the 18th century, Lloyds has become an institution synonymous with Britain's financial landscape. But its journey hasn't always been smooth sailing. In the early 20th century, Lloyds, like many other banks of its time, faced a series of challenges. World wars, economic depressions, and changes in financial legislation all played their part in shaping the bank's destiny. Yet through it all, Lloyds remained a steadfast pillar of the UK economy. Fast forward to the 21st century and the banking sector faced a new crisis, the global financial crash of 2008. In response to the collapsing financial system, the UK government made an unprecedented move. They intervened directly in the banking sector, including purchasing a stake in Lloyds Bank. This was not a decision taken lightly, but a necessary measure to stabilize the economy and protect millions of people's savings. It's essential to remember that this wasn't the first time the government had intervened in the financial sector. In the past, during times of economic distress, the government has stepped in to ensure stability. But the scale of the 2008 intervention was unlike anything seen before. This intervention was a clear demonstration of Lloyds Bank's importance to the UK economy. It was a signal to the world that the UK government was prepared to do whatever it took to protect its financial system, even if that meant becoming a stakeholder in one of its largest banks. So, when we consider why the government bought a stake in Lloyds Bank, we must remember the bank's historical significance and the government's track record of stepping in during times of crisis. With this historical context in mind, the government's decision starts to make a bit more sense. So, what led up to the government's decision to buy a stake in Lloyds Bank? The answer to that question lies in the tumultuous events of the late 2000s. The world economy was in turmoil. The housing bubble had burst, leading to a domino effect that rippled through the financial sector. Banks across the globe found themselves on shaky ground, and the UK was no exception. Lloyds Bank, one of the country's largest financial institutions, was not immune to these pressures. It was a challenging time, to say the least. The bank was grappling with mounting bad loans and a deteriorating financial position. The situation was growing dire, and it was clear that Lloyds Bank needed a lifeline. Meanwhile, the UK government was watching these developments closely. The health of the country's banking sector was critical to the overall economy. If a bank the size of Lloyds were to fail, the impact could be catastrophic. Jobs would be lost, businesses could fold, and the public's trust in the financial system could be irreparably damaged. The government knew they had to act, but how? And to what extent? These were the questions that policymakers grappled with as they considered their options. On one hand, they could let market forces play out, potentially leading to the collapse of a major bank. On the other hand, they could intervene, offering support in an attempt to stabilize the situation. In the end, it was the risk of doing nothing that swayed the government's decision. The potential fallout from a banking collapse was simply too great, so they chose to intervene. They decided to buy a stake in Lloyds Bank. This move was not without controversy. Critics argued that it was a dangerous precedent, a case of the government meddling in the free market. But for the government, it was a calculated risk, a necessary step to protect the economy and the public. The decision was made. The government would buy a stake in Lloyds Bank. What happened after the government bought a stake in Lloyds Bank? This question brings us to the immediate aftermath of the government's decision. A period of profound change, not just for Lloyds Bank, but for the entire UK banking sector. In the wake of the government's investment, Lloyds Bank underwent significant operational changes. A fresh influx of capital provided the bank with a much-needed financial lifeline, which enabled it to weather the economic storm. The bank was able to continue its operations, thus ensuring financial services for millions of customers across the UK. However, this was not just a lifeline for Lloyds Bank, but also a lifeline for the UK banking sector. The government's decision sent a clear message. It was committed to stabilising the financial sector. This move bolstered the confidence in the UK banking industry, which had been noticeably shaken. The public reaction to this decision was mixed. On one hand, there were those who saw it as a necessary step to prevent the collapse of a major bank, and by extension the UK banking sector. On the other hand, there were critics who questioned the prudence of using taxpayer money to bail out a private institution. The government's decision also sparked a broader debate about the role of government in the banking sector. Some argued that the government's stake in Lloyds Bank marked a move towards a more interventionist approach, while others saw it as a one-off response to an extraordinary situation. In the immediate aftermath, it was clear that the government's decision to buy a stake in Lloyds Bank had altered the landscape of the UK banking sector, but what was less clear was the long-term impact of this decision. The dust had settled, but the long-term impact of the government's decision was yet to be seen. Now let's delve into the long-term impact of the government's decision. The decision to acquire a stake in Lloyds Bank has undoubtedly cast a long shadow over the UK banking sector. It's an example of the government's active role in steering the economy during times of crisis. The immediate aim was to stabilise Lloyds Bank, but the ripple effects have been far-reaching. Firstly, the government's actions have had a profound effect on Lloyds Bank itself. The bank was able to stay afloat and continue its operations, ensuring continuity of service for its customers. It also allowed the bank to restructure its operations, becoming more resilient in the face of future economic shocks. But the impact extends beyond just Lloyds Bank. The government's decision sent a powerful message to the entire UK banking sector, a message of confidence and commitment. This move reassured not only other banks, but also investors, customers, and the public at large that the government was willing to step in and protect the banking sector during turbulent times. It helped to restore trust in the UK banking sector, which had been severely damaged by the financial crisis. Furthermore, the decision had significant implications for the UK economy as a whole. By preventing the collapse of a major bank, the government helped to mitigate the risk of a more severe economic downturn. The stability of the banking sector is crucial for the overall health of the economy, as banks play a vital role in providing credit and facilitating economic activity. Therefore, by stabilising Lloyds Bank, the government helped to safeguard the broader UK economy. In the years since the government's decision, the UK banking sector has undergone considerable changes. Banks have become more cautious, focusing on strengthening their balance sheets and improving their risk management practices. The government's intervention in Lloyds Bank served as a wake-up call, prompting banks to take steps to ensure their own stability and resilience. However, the long-term impact of the government's decision is still unfolding. The banking sector continues to face challenges, including the ongoing effects of the COVID-19 pandemic, Brexit, and the transition to a digital economy. The experience of Lloyds Bank serves as a reminder of the important role that the government can play in supporting the banking sector and the economy during times of crisis. The government's decision to buy a stake in Lloyds Bank has left a lasting impact, shaping the future of the UK banking sector. So, why did the UK government decide to buy a stake in Lloyds Bank? We've journeyed through the past, delving into the reasons that led to this critical decision. We learned that it was a strategic move to stabilise the economy during a turbulent financial period. The aftermath? Immediate stabilisation, yes, but also a ripple of consequences that echoed through the banking industry and the wider economy. The long-term impact has been a mixed bag. On one hand, the government's stake has allowed for greater oversight and regulation, fostering a climate of accountability. On the other, it sparked debates around government involvement in private sectors. This episode also highlights the resilience of economies and the dynamic relationship between public policy and financial institutions. The government's intervention wasn't just about saving a bank, it was about safeguarding the economy, protecting taxpayers, and maintaining public trust in the financial system. The government's decision to buy a stake in Lloyds Bank is a fascinating case study in economics, public policy, and the complex interplay between government and industry.